Hello, how are you doing? Today we will cover IPSAS 24, which is presentation of budget information in financial statements. So IPSAS governs or is applicable to public sector accounting standard, public sector, so NGOs and governments. So what we'll be covering is presentation of financial information in financial statements. My website is learnipsas.com. I will begin with a quote. Budgeting. So what is this budgeting? Budgeting is not just for people who do not have enough money. It's for everyone who wants to ensure that their money is enough. This is a quote borrowed from Rose Wamambe. Rose Wamambe. So budgeting is not just for people who do not have enough money. If you do not have enough money, then it's not just for only you. It's for everyone, whether you have enough money or not, who wants to ensure that their money is enough. Who wants to ensure that their money is enough. So introduction to budgeting. Budget is an operational plan expressed in financial terms and based on expected income and expenditure for a definite period. So sometimes budget can be multi-year or 1 year, so for a definite period, but usually it is for a year. The budget is an important instrument of resource mobilization, allocation, and management in both private and public organizations. For private organizations, they are not obliged. It's not must for them to draw or prepare a budget, but when they do, they rarely also publish them. In government, it's not only mandatory to draw the budget, but it's also mandatory to publish them. So most of the times you will find that in government entities or public sector entities, they tend to publish those budgets. So if you have had an opportunity to read IPSAS, you may have found that IPSAS 1 under paragraph 21, it stated that a financial statement is not complete. Financial statement is not complete without, one, this statement of financial position, sometimes called balance sheet, a statement of financial performance, sometimes called income statement, a statement of cash flow, a statement of changes in net assets stroke equity, and then our focus today is here, statement of comparison of budget and actual amounts, and notes to the financial statement, so the notes. So this 1, 2, 3, 4, 5, 6, these are 6 items which are the components of a financial statements under IPSAS 1 paragraph 21, of which budget is one of them. So there are processes. Normally when one is preparing budget, they follow most of the times, whether government or an entity and a private entity. The budget process is an important part for government. So as I'm dealing with IPSAS 24, for government is used for planning and decision making. The budget making processes in most countries begins in August. So say in our case Kenya, our budget normally is executed from July to June. But then immediately when execution starts on July, after July, then August, you start preparing for the next budget. So begins in August of the current financial year to December of the next. So to December of the next financial year. I will show you why up to December, why it normally takes to December, because of execution and also oversight. A financial year or a fiscal year or sometimes a budget year is the period government use for accounting and budgeting purposes and financial reporting. It varies between countries. Some countries are from January to December, other countries from July to June, depending on where or which country you are in or that jurisdiction. A full financial year in most countries begin 1st July. So in most countries it begins 1st July of the current calendar year. Calendar year, when I'm speaking of calendar year starts from January to December. January to December. But then financial year can be from July to June or January to June. So there is a difference between calendar year and a financial year. So the second is a financial year can have 4 quarters. A financial year can have 4 quarters, each comprising of 3 months. So in those countries whose financial year starts from 1st July, then the first quarter begins from 1st July to 30th September. The second quarter begins from 1st of October to 31st December. And then third quarter begins from 1st January to 31st March, and fourth quarter begins from 1st April to 30th June. This normally is the fourth quarter and also the financial year. So it is when the year is ending 30th June. So a financial year is in most countries is from 1st July to, so the process, the budget process, finalizing here the budget process, there is the first process, or the first line is budget formulation, is when the budget is formulated. It normally starts from executive level, where the executive orders first they provide budget circulars, and those circulars are sent to local and national government, and the national government they are sent to entities, specific entities, and then they provide budget policy statements. Each entity will provide its budget estimates or budget draft, whereby each department is told, or within that entity, each department is told to come up with their budget estimates for the next financial year. After that, the budget draft is compiled and taken to public participation before it's taken for approval. The next stage, that was stage 1, budget formulation. The next stage is budget approval. Here is where in parliament or local parliament is, national or local parliament is involved. It involves adopting of the budget policy statement. So whatever that the estimates that was compiled by entities is now adopted. But then before it's adopted, sometimes it is amended, sometimes with little amending, and then finally approved. When a budget is approved, it becomes what? An appropriation bill. An appropriation. When you hear about appropriation bill, then it's enacting the budget. It's enacting the budget. So these are the 4 processes. So the third process, the third process is budget execution. Yes, the budget is approved. Yes, the budget is approved by parliament. Then it is where you execute the budget. It's where you start utilizing that money. You start spending that money. So after spending the money, accountants are required to prepare quarterly reports, year-end reports, and along the way, something might happen that necessitates for supplementary budgets. For example, a drought. For example, floods. Other examples is sometimes some scenarios happen where COVID-19 came. So you will develop supplement, or sometimes even the revenue you have collected might not be enough to execute the whole approved budget. Then there is the need for supplementary budget. And then finally, the budget oversight. This is where the financial statements or whatsoever that was executed under stage 3 is audited. So the auditor general comes in, or whichever name you call it in your jurisdiction. So the financial statements are audited, and then there are reports provided by certain committees, parliamentary select committee or others, and then there is legislative audits. So the public audits whatsoever, or the oversight authorities audit whatsoever that was executed under stage 3. So what is objective of IPSAS 24? Objective of IPSAS 24. IPSAS 24 requires a comparison of budget and actual amounts. So the actual amounts arising from the execution of budget to be included in the financial statements of entities and governments that are required to, number one, you are required to prepare this, or you have elected as a GPE and you made your budget publicly, approved budget publicly available, for which they are therefore held publicly accountable. Since you are accountable to the public, then you have to provide a comparison of budget amounts and actual amounts. This standard also requires disclosure of an explanation, so you are also required disclosure of an explanation of the reasons for material differences, so between the budget and actual amounts. So what caused the material differences between the budget? So you are required to also provide, when we are doing our example, that's where you will see what is required. So the scope, who prepares this? An entity that prepares and presents financial statements under the accrual basis of accounting shall apply this standard. This standard also applies to public sector entities other than GPEs, that are required to elect or make publicly available the approved budget. So all entities that are not GPEs can apply. But what are these GPEs? GPEs are government business enterprises. They behave like private entities or private companies. In that they make profit and compete against other companies. Example, postal services, railing companies, Kenya, for example, in Kenya, Railways, Kenya Airports Authority, or even in your area, you may have certain distinctive entities that compete and behave like private entities. For these entities, they use IFRS stroke IAS, they use International Accounting Standards or International Financial Reporting Standards. So since they make profit or loss, these entities make profit or loss. So what are the key terms used under this IPSAS? IPSAS 24. Remember, IPSAS, we said International Public Sector Accounting Standards. So there is the original budget. Mind you, I sometimes joke and say original budget, there is no fake budget. So original budget is the initially approved budget for the period. So sometimes budget can be for 1 year or many years. So that is a multi-year budget. The final budget is the original budget that covers for adjusted for reserves, carry amounts, transfers, allocations, supplementary and other authorized legislative changes applicable to the budget. So the original budget, the O, plus adjustment is equal to final budget. So we said that sometimes there are situations that might cause the budget to be adjusted. Supplementary appropriations, revenue, shortfall of revenue, floods, drought, other issues might arise that may cause the government or entities to make adjustment to the original budget. Therefore, the final budget is what's called, or the adjustment to the original budget is called the final budget. The other key terms is comparable basis. Means the actual amounts presented on the same accounting basis, same classification basis for the same entity and for the same period as the approved budget. So comparable basis. You can compare apples to apples or mangoes to mangoes, but you can't compare apples to mangoes. So you can only compare apples to apples. So when you're comparing the budget to actual amounts, so you can compare, for example, a cash basis budget, you can compare with cash flow, or an accrual basis budget, you can compare with the statement of financial performance. And then those line items, use of goods, for example, you cannot compare use of goods with general expenses. So you have to compare line by line on the same basis. So the actual amounts presented on the accounting basis, same accounting basis, same classification basis for the same entities and for the same period. So you cannot also compare last year to this year. You can only compare this year to this year financials, not last year, or a 1 year budget to a multi-year budget. Actual amounts. The actual amounts uses the term actual or actual amounts to describe the amount that results from the execution of budget. In some jurisdictions, it's called budget outturn or budget execution. So actual amounts can also mean budget outturn or budget, or similar terms may be used with the same meaning as actual amount. So this is what you have spent in cash for that year. Actual amounts you have spent. If you are on cash basis, the actual spent on cash. If you are on accrual basis, actual you have spent on accrual. So the actual amount. Remember, when I mean actual amounts, it depends with your budget. If your budget is cash basis, the actual amounts you relate to cash flow. If your budget is on accrual, the actual amounts is related to the statement of financial performance, or sometimes called income statement. So, level of aggregation. In some cases, the detailed financial information included in approved budget may need to be aggregated. Why do you aggregate? For presentation in financial statements in accordance with the requirements of this standard. Since we normally compare actual to actual basis or comparable basis, you have to aggregate. You may find that there are several lines in the approved budget. So all those lines, you bring them together and aggregate as per in a way that is comparable to other statements. Such aggregation may be necessary to avoid information overload. Yes, true. This is true because sometimes you have 1,000 lines in the budget, 1,000 lines. But then this statement is for general purpose. So when you don't aggregate and you have those several lines, how many pages of financial statement will you have in your report? There will be a huge overload. There will be many pages. To avoid that, we normally aggregate and reflect the relevant legislative or other oversight level. Determining the level of aggregation will involve a lot of professional judgment. The figures will remain the same, but the totals will be aggregated in line using professional judgment, which will be applied in the context of the objective of this and the qualitative characteristics of financial information. So qualitative characteristics. If you have read the conceptual framework or IPSAS 1, you may have seen that there is what's called qualitative characteristics. So classification of differences. So when you prepare the budget, the actual amounts on comparable basis, you might find sometimes there are differences that might arise. So classification of differences on comparable basis in the financial statement. Those differences can either be basis difference, timing difference, entity difference, or sometimes formats and classification differences. So basis differences occurs when the budget is prepared on a cash basis, yes, and then or modified cash basis, and the financial statements are prepared on accrual basis. So in such scenario, there is or that may result in basis difference. So your budget is cash, but your financials are on accrual. Such may cause a basis difference. Timing difference occurs when the budget period differs from the period reported or reflected in the financial statement. So the budget period is for the previous year, say the previous year 20x5, and then the financial statements are for 20x6. So those difference can cause budget or timing difference. For example, sometimes you might pay in the budget, you might pay retention money. That retention money, which you have assumed that you have paid but you have deposited in a deposit account, might cause a timing difference, because in the budget it is recognized as paid, but in the cash flow it is not recognized as paid because it is not actually a cash outflow. So to avoid rebudgeting for this money, in the budget you pay, but then Under the cash flow, it's not yet paid because the money is still in one of your deposit accounts. So it can, as soon as once you confirm the certificates and everything, and you confirm everything is in order for that project, then you pay, but you don't re-budget because it was part of the previous. So timing difference can arrive in such scenario. Entity difference occurs when the budget omits programs or entities that are part of the entity for which the financial statements are prepared. Sometimes in the budget, you might find that there are some certain programs that are included are included in the budget but are not yet spent, or sometimes even the money is paid direct when it's a loan or in some countries. But a good example is in our jurisdiction in Kenya, we have what's called return to exchequer. This is not budgeted for in the budget. So what happens is, at the end of the period, any unspent money, not those in the deposit account, but unspent money in the recurrent and development amounts, are returned to exchequer, and this is not budget, and this can cause the omission of programs or items to be returned to because it is not known, it's only unspent money. So this may be as a result of entity differences. There are at times that there may be differences in formats or classification. So the budget is classified, or the financials are classified under functional classification, and the budget is under economic classification. Such may arise, but it is not so common because most of the times the financials and the budget are presented in the same comparable basis. So what can cause the change from original to final budget? An entity shall present an explanation of whether the changes between original and final budget are consequences of. So this is one of the reasons: reallocation by way of notes, disclosure in the financial statements, or in the report issued before, at the same time, or in conjunction with the financial statement. So someone can provide another report and present this information, the reasons for the change. So other times, changes from supplementary appropriation may be necessary where the original budget did not adequately envisage expenditure requirements arising from, for example, war or natural disaster. In addition, there may be a shortfall in budgeted revenues during the period. So an internal transfer between budget heads or line items may be necessary in such a scenario to accommodate for changes in funding priorities during the fiscal period or the financial year. The final budget, therefore, includes all such authorized changes in amendments. So how do we present or presentation of comparison of budget and actual amounts? Subject to the requirements of paragraph 21 of IPSAS 24, an entity shall present a comparison of budget amounts for which it is held publicly accountable against actual amounts. The following are important when doing a comparison as per budget IPSAS 24. The original and final budget, these are very important. The original and final budget amounts, the actual amounts on comparable basis, and by way of disclosure, an explanation of material differences between the budget for which the entity is held publicly accountable and actual amounts. So I will be showing you how this is presented in an example that follows this presentation. An example which shows how to calculate and how to reconcile. Note to the disclosure of budget basis, period, and scope. An entity shall explain, identify, or disclose in the notes to the financial statement the budget basis. The classification basis are adopted in the approved budget. Again, an entity shall also disclose the period of the approved budget. If it is 20x 5 again the period. If it is 20 x6, so they will show the period. The entities included in the approved, how many entities are included? Is it just one entity, your entity, or it has several other entities? The differences between actual and budgeted amounts. In our jurisdiction, where we see there is a 10%, and if you spend less than 90% in our jurisdiction, 90%, we normally, if you spend less than 90% in our area, we normally say then you have to provide explanation. If you spend just less than 90%, you provide an explanation why you have spent. Or if you spend more than 100%, even if it is 0.1, you have to explain why you have overspent, because budget is an approved budget. And the moment you overspend, who gave you the authority to overspend? What are the differences? Where there are differences between the financials and the budget, then you also provide a reconciliation. You also provide a reconciliation. So let us go to this example and tackle together. Let us go to this example and tackle together. So this is the illustration. This is my number 2, but for today it's my number 1 illustration, entity XYZ. Entity XYZ, the illustration below for entity XYZ. The original budget for financial year 20x2x1 was Kenyan shillings 1 million. So as per my restriction, I'm using Kenyan shillings 1 million. It's 1 million. 1 million. Okay, thank you for your patience. Is 1,150,000, which was approved by the relevant authority on 29th June 20x1. So most of the times you might see budget covering 2 periods, 2 years, but then it's 1 year, because if you start from a period July 20x1 and then ending June 20x2, 30th June. So beginning first and then here started June. So there were no subsequent revisions or additional appropriations made to the approved budget through specific approvals from the appropriate authorities. Therefore, entity XYZ budget is prepared on cash basis. So the budget here is prepared on cash, whereas the financial statements are prepared on accrual basis, using a classification based on the nature of expenses in the statement of financial performance required. Prepare a statement to reconcile the actual amounts on a comparable basis included in the statement of comparison of budget and actual amounts with the actuals as per the statement of cash flow. So here we were guided direct prepare. So since cash flow is cash basis, budget is cash basis, so these two statements can be or are comparable. So let us go to the our cash flow. This is our cash flow statement. Transfer from exchequer is 700, rendering of services is 200,000, total receipts is 900,000, employees cost 200, use of goods 150,000, other grants 50,000, social benefits 100,000. So all this information. So net cash flow from operating activities is 400,000, net cash flow from investing activities 250,000, and net cash flow from financing activities is 100,000. So this is our cash flow. This is our cash flow statement. And then this is what I was telling you about, statement of comparison of budget and actual amounts. So this you will find that most budgets, if it is cash basis, you will find it is receipts, payments. But if it is accrual basis, you will find revenue and expenditure. Expenditure might include operating expenses and development expenses or capital expenses. So in this case, the budget is cash basis and the cash flow is cash basis. So there is the original budget. This is the original approved initially approved budget. And then this line is the original budget. This line is the adjustment or reallocations. And then this line is final budget. Remember, final budget said is the original budget minus or plus the adjustment, and then you get what? The final budget. And then the actual amounts, you remember the actual amount, this is taken from cash flow. This is taken from cash flow. So budget utilization differences. So initially your final budget was 800. What you spent is 700. Your budget originally was 800. What you spent is, so here the formula is here, E is equal to C minus D, which is 100,000. And then this is the percentage. This is the percentage of utilization, D all over C, D all over C, D all over D all over C, D all over C. So D all over C is our budget up as a percentage is a percentage of utilization. It is very simple. Budget is very simple. Then let us see if there is any difference. If you see the surplus or deficit as per our budget is 100. The surplus or deficit as per our budget is 100, while the surplus or deficit as per the statement of cash flow is 50,000. So what is causing? What's causing the difference? Where is the difference coming from? Let us look at line by line. 700,000 is here. Let us go to cash flow. There is 700,000. The next one, there is 200,000. Let us tick. There is 200,000 here. Is there any 200,000 there? Yes. There is 200,000. Yes. And then employees cost, there is 200,000. Employees cost 200,000. That one is okay. And then let us also take this 200,000. Is there 150? Yes, there is 150, which is use of goods. Here is 150. And then this other part is also 150. Let us go again. There is other grants 50,000. Other grants 50,000. Here also 50,000. And then there is this 100,000. I guess there is also that 100,000. So total operating expenses is same, 500,000. So operating expenses or net cash flow from operating activities are same. Then acquisition of PPE here is 300,000. Acquisition of PPE. So let us go to investing. Investing, we have 300 here. We have 250,000 here. 250. You can see here 250. While here we have how much? We have 300. So this is one area of differences. One of the reasons I told you that might cause the differences is retention money. As per budget, it is assumed that you have spent this 300. Reason being, you cannot budget again for that 300,000. Even though you retain the 50,000, you can keep the money somewhere in your deposit account, so that as soon as you confirm that project is 100% complete and there is no alterations or a feature adjustment that is required, then you give it to the client or the supplier, that money. So you just set that money aside. It was part of their budget, you keep aside, because as per the certificate of completion, that project is complete. You just need to confirm one of two things. So in Kenya, we normally practice this and say that this money is kept aside. It is taken into a deposit account. Even when we are returning money to Exchequer, or Exchequer is taking back some money, or it's returned to the Ministry of Finance, we normally return some money, unspent money, back to National Treasury or the Ministry of Finance. So that money is never taken back because it is retention money. Retention monies are never taken back. So under budget, it's assumed it is spent. But then, did that money really move out of your bank account? No, it didn't, because you have transferred from the current account to the deposit or retention account. So it has never went out of that money. That's one. The other one, which is not budgeted, is the Exchequer money. This is Exchequer money. This one is Exchequer money. This is not budgeted. This is not budgeted. If it is not budgeted, because it is the unspent money at the end of the year. So we can't see any line here that states that return to Exchequer. It is not envisaged. It is not expected that at the end of the period there are returns to Exchequer, because under the budget it is expected that everything that you have budgeted for, you will spend. So those are the two differences. And how do we reconcile? How do we reconcile? We normally reconcile. This is how the reconciliation looks like. Reconciliation, these are the headers. If you look at this standard, these are the headers: operating, financing, and investing and financing, and this is the total. So you start with the figures as per the budget. So as per the budget, what is the balance? What is the net from operating? What is the net from operating as per the budget? As per the budget, it is 400, 300, and 100. It's 400, 300. So financing, there's nothing called financing in our budget. So this is as per our budget. This is the totals. 900 minus 400. This is from operating, that is 400. And then investing, it is what we have invested is 300. What we have invested is 300,000. And then our total is financing is 0. So as per the budget is 400, 300, 0. Then we want to arrive the balance as per cash flow. So you can either start with the cash flow or this. So since there is no adjustment for this, for the budget is 400, but for the cash flow is also 400. Can we confirm that? Yes, this is it. So total income less total expenses, or total receipts less total payments. 900 minus 500. So the balance is 400 as per the cash flow. So is that the case as per the reconciliation? Yes, this is a tick. Let us go to investing. Investing as a budget is 300. But then we have noted that what we have spent under cash and what we have spent under budget due to timing difference is 50K. Why? How much do we spend under cash flow? We have spent 250. We have spent 250. How much do we spend under the budget? How much do we spend under the budget? We have spent 300. Why? We said budget is it's expected that you will spend the 300K because you have paid the supplier 250, and the 50 you set aside in your deposit account. It will never be part of the money you will return to the exchequer. So total spend is 300. So the difference here is this is the difference. So you say you have started with 300, or you have spent minus 300,000, and then due to timing difference and due to that retention money, you have spent 50,000. So under cash flow, what are you expected? The total expenditure as per cash flow is, because of these two differences, is 250. Let us go to financing. Here, financing under the budget, there is none. There is no money that came in or came out because it wasn't budgeted. Return to exchequer is never budgeted. But how much did you return? How much of this money did you return to exchequer? Which is 100,000. You have returned 100,000 to exchequer. So since you have returned 100,000 to exchequer, then you say you have started with 0, returned 100,000, returned 100,000. You have started with 0. We have started with 0, and the difference is 100,000, and you have ended up, sorry, this is an oversight. This is an oversight. Sorry, this is 100,000. The total is minus 100,000. The total is minus 100,000. So the total is minus 100,000. The total is minus 100,000. So 400 minus 250 minus 100,000. That is 400 minus 350. That is the total. And again, if you do vertical, 100,000 plus 50 is 150, minus 100 is 50. So that's how you reconcile the differences. This is an explanation between the actual amounts identified consistent with the comparable basis and the actual recognized as explained. Retention money. Retention money is recorded as an expense in the budget immediately, while in the financial statement it is recognized later when the cash is actually released, resulting in a timing difference. Return to exchequer is not part of entity XYZ budget because it falls outside the entity scope. It falls outside the entity scope because it is never budgeted, but it appears in the financial statement, creating an entity difference. In the budget, retention money is recorded as paid out when the work is performed, assuming the full payment has been made. However, the financial statement and cash flow, the actual cash is retained for a few months as a liability until the work is fully verified, and the payment is released. This creates a timing difference as the budget records the expenses immediately while the cash movement occurs later. Return to exchequer, the approved budget for entity XYZ excludes transactions involving returns to exchequer as these funds fall outside the budget scope. True. In our case, the 100,000 is returned to exchequer because unspent funds are transferred back to the National Treasury or Ministry of Finance, depending on your country. Since the budget does not include transactions, but the financial statement capture it as a cash outflow, I have classified this difference as an entity difference. Again, that is the reconciliation. Also, you will provide explanation of the differences between these two. Is it because of reallocation or other factors? So it is a requirement you provide below this budget statement or in the notes or a statement in conjunction with this. So it is easier for most of the times to provide under this statement both the reconciliation and the explanation, the reasons for the adjustment. So with that, I think we have learned few things on budget for today. So hopefully we will meet again covering other IPSASes. Please follow this account for future IPSAS update. Also, there is a website I normally update this information. If you are a fan of reading more, that IPSAS is learnipsas.com. Thank you for your attention and enjoy your day.